is where we are. So this year is going to be an ugly year for headlines. No question about it. So when asked about, politics and health, this is a poll done by NBC. 12% of people are saying it's affected health negatively. 38% of people say it's caused stress. 20% of people say it's damaged relationships. 30% of people, they've lost their temper with people. I did this with my dad. Like, anyone had a fight with a close friend and you're not talking to that friend anymore? Okay, so no, maybe not, you won't admit fight. Has anyone unfollowed on Facebook somebody that you're sick and no one's gonna admit it? Okay, 2 of you. I don't believe it. I believe it's more than half of you. It's more than that. Yeah, it's gonna be an interesting year. And there's a lot of good things here. Like they did a Good News Network. Anyone look at Good News Network? You really should, because it's more, feels better. They ask, what are the things you like about the United States? Founding Fathers is one of the things someone said. Freedom of speech and religion so far. Rock and roll, the blues and jazz. This is fantastic. National parks, oh my God. Innovation, diversity, generosity. There's a lot of statistics about how the US government doesn't give as much as other governments do, but we do. Individuals in the United States give an enormous amount of money to support things. National, international, local causes. We give an enormous amount of money. Our client base, you give a lot of money to things. So we as a country don't, the United States doesn't. We could do more, but we as individuals give it a lot of money. Okay, so something happened mid-year last year that was a change in direction. And that was, what we see here on the top is we see tightening is above this line, and then loose monetary policy is below that line. So it's not just the United States. Europe did it, we did it, Japan did it, emerging markets did it, China did it. Once we had a question about growth, we weren't sure we're going to have the kind of growth we wanted. The next thing that the central banks did was they eased. Sometimes they reduced rates, sometimes they engaged in quantitative easing. You might remember that from 2009, 10, 11, okay? We're all easing now. Like that is the status. We have a very, very easy environment for risk assets. And we still expect growth. More in the emerging markets. We see that down here. In the US, I've seen, this is sort of the average print. This is The Economist. But I've seen everywhere from 1.6 to 2.5, depending on who you're reading. And if you're a Keynesian, you're leaning towards 1.6. If you're a supply sider, you're leaning towards 2.5. We don't know what the reality is, but it's probably going to be continued plow horse, slow growth economy. That seems to be the most likely outcome that we're going to see in the United States. Okay, look at this one. I don't even know how that's incredible. But there's a lot of growth out there in these teeny tiny little countries. There isn't really a sign that GDP is going to turn in 2020. It's not going to go negative. No one is suggesting that that's possible. It may be that there's more pressure on earnings because there's going to be more inflation. It'd be harder to pay for labor because labor is getting more expensive, which is something out here we actually like and we want. Companies don't like that, don't want us. Our stock portfolios don't like that. But it's probably a good thing for humanity, for our neighbors. So the reason I put this in there is because there's an expectation, and there's a lot of this conversation in the news right now, that we are spending ourselves into oblivion right now, right? But this is, take this with a grain of salt. This is the Office of Management and Budget, the White House. So they're suggesting that in 2021, we'll see the peak of our spending relative to what we take in. And then the growth will kick in and we'll see that come back down. And it remains to be seen. Yeah, it remains to be seen. We don't know. Okay, we're going to go through a few quotes, and there's one in here that I assume someone will object to the author. So I'm just, take a look at the authors. Strong fiscal outlook is an essential foundation for a growing, thriving economy. With a strong fiscal foundation, the nation will have increased access to capital, more resources for public and private investment, improved consumer and business confidence, and stronger safety net. Unfortunately, the opposite is also true. Okay, so this is one of the risks that we're seeing. We're seeing a lot of, well, it's kind of a steady increase, but there's a lot of corporate debt. The thing that this number doesn't show you is there's a lot of low covenant corporate debt. So there's a lot of debt that if it defaults, there's nothing that the lender can do about it. It's not tied to assets. It's not recoverable. It doesn't have the same kind of teeth in it. So if you think about when this happened kind of before was housing lending in the 2006, 7, 8. When it gets really, really, really easy to borrow a lot of money and there's not a real way to recover it, this is that kind of an issue. It's a much smaller scale and doesn't have the same effect on us as housing lending does, but corporate lending is an issue. There's a lot of noise in this because some of the corporate borrowers are places like Apple, who've borrowed a lot of money, but they also have a lot of cash. Right? So this is not as bad as it looks because there's a lot of asset behind some of the things like these really good companies are borrowing because they can, because it's so incredibly cheap. So this was actually printed before Iran. And this is the global risk index, the macro risk index. And so right now, it's up in here, right? Trade tensions were bad. Potential Middle East issues are worse. So it's something to watch out for. This is one of those other risks that we might run into. Okay. Trade drives economic activity, especially business investment. Indeed, we have seen a decline investment in many. So this is last year. We had a fantastic consumer economy last year, and businesses didn't invest. We're going to see this. So this is the last 2 quarters, right here, and this bar right here. I think that's orange-ish, rust-colored. It doesn't exist here. See how it's just a teeny tiny line at the end? Negative. That's business investment. So notice how is it, why do you think business investment's down? We've talked about it here before. Why is business investment down?
Because they don't know what to expect.
Right. It's mayhem. And they're not going to put money in there to work if they don't know if they're not going to build a plant in Kentucky if they don't know what's going to happen next. They're not going to build a plant in China unless they know what's going to happen next, and they don't know what's going to happen next. So businesses are retrenching or holding their capital back. But what does that mean for tariff issues being resolved? What does that mean if we start playing nice with our trading partners? Not nice, but nicer. We're never going to be nice, but nicer. Right? That will relieve a lot of this. We'll see a lot more business investment. And if that's the thing that's dragging, so when you talk about people who have the 2.5% GDP expectation, they're looking at that. They're saying probably the tariff issues will be resolved, at least in part. So that the idea is when GDP increases or the expectation of GDP improving is based on that possibility that the tariff war ends. And so the people that are assuming 1.5 and 1.6, it's probably based on the assumption that the tariff war doesn't end, right? So you never know what assumptions go into someone's prediction. So this is very interesting. And this kind of what we just talked about, right? Consumer sentiment is up year over year. Consumers are doing really, really well. Really well. Debt loads are low. Wages are actually increasing. We talked about this a little bit, I think 6 months ago. The wage number is increasing, but it's actually increasing more for lower wages than it is for higher wages. And we're talking about wages, not profits. Profits are increasing more than any of that, but low wages are increasing faster than high wages. But this is admittedly from a very high point, but still that's a big number right there. Right? That tells us that businesses are just not comfortable investing. Okay, so we've talked about GDP estimates. This estimate from Federal Reserve is about 1.9. Again, seen 1.6 to 2.5. We talked about the reasons for that. This, I think this is crazy. And by the way, this just printed at 2.1. Wait, no, it printed at 2.3. The most recent numbers, I think, were this morning, and they were 2.3. They're higher than expected. That should cause us a little bit of pause. We've been pushing, trying to get it. And now we may have, and I've read a couple people starting talking about, maybe we're beginning an inflation cycle, right? Which might be good for a little while, but if it goes, it can get scary. This, I don't know what they're thinking here. We're at 3.5 right now, and we're creating jobs like mad, like 100,000, 150. If we create 150,000 jobs a month for the next year, that'll be 3.3. That's pretty much what we did the last 2 years. So if we continue on the pace, maybe we will, maybe we won't, that'll go lower. Many of the estimates I listen to, the people I listen to, are saying it's going lower, 3.3, 3.4, that's what they're saying, which means wages have to go up. And you talk to business people, especially here in the Bay Area, it's so hard to find people. I've lucked out. With Paul and Sarah and Gail, lucked out. It's very difficult.